One of the most expensive stock in our country is MRF. As of this video's recording, its share was trading at 83,500 rupees, which makes it quite unaffordable to most retail investors. But MRF is not the only one. Others such as Abbott India, Procter & Gamble Health, Shree Cement, Maruti Suzuki, Ultratech Cement and many others also trade at very expensive prices. So the question is, are they expensive because they are top-notch, high-quality companies? Well, just because the stock price is expensive does not in itself necessarily mean that they are great companies. One of the reasons these companies trade at high prices is because they have not split their shares. You see, when a company's stock price rises so much that they become unaffordable to small investors, many companies split their shares to prices that become more budget friendly. In October 2021, for instance, IRCTC's stock split by 1:5, which means that every share was split into 5. So for every one share, the company issued 5 new shares. But does this mean that you will have free money? Absolutely not. Even though the number of shares outstanding in the market increases, the price also gets divided by 5. So the total value of your investment remains the same. Similarly, very recently, Bajaj Finserv split its shares. In October 2021, Bajaj Finserv's share touched approximately 20,000 rupees per share. But in July this year, the company split its shares in the ratio of 1:5, which means that every single share was divided into 5 equity shares. So from around 20,000 rupees, the price reduced by a factor of 5 to 4,000 rupees. But the number of shares increased 5-fold. This is to say that the total value of shares remained the same. In other words, the value for you, the shareholder, did not increase by the split. So the question is, why do companies split their shares? Well, the answer is to make it more affordable to small investors. When the share price is low enough, then more investors can afford to buy them, and this leads to a growth in investor base. The company gets a variety of investors, but this is not always good because when the share price is low, it also tends to increase a lot of speculators. The best example of this is penny stocks or small cap stocks, right? Because the price of these penny stocks is so low, a lot of gullible people who are beginners in stock markets are lured by random stock tips that claim the stock's price would rise from, let's say, rupees 12 to rupees 20 in a span of 2 weeks. These penny stocks are avoided by large institutional investors, so they are also easy to manipulate. In comparison, big stock prices tend to attract more stable, long-term investors, so they are not as easy to manipulate. In fact, this is the primary reason why Warren Buffett hates stock splits. In fact, his firm Berkshire Hathaway has 2 separate class of shares. The original Class A shares, which have not split, trade at about $4 lakh today. To be sure, Berkshire does have Class B shares, which have split earlier and are more affordable to small investors. They trade at $270, but these Class B shares have lower voting rights. So if you want to vote on important decisions of the company, then your voting rights may not be equal to those who hold Class A shares. So why will Berkshire never split its Class A shares? Well, Warren Buffett explained this in 1995 annual shareholder meeting. He said, I know that if we had something that it was a lot easier for anybody with $500 to buy, then we would get an awful lot of people buying it who didn't have the faintest idea what they were doing, but heard the name bandied around in some way. And secondly, to the extent that ever created a market that was even, that was stronger, you then would have people buying it simply because it was going up. We got a little bit of that going on this year. There are a lot of people that are attracted to stocks that are going upward. It doesn't attract us, but it attracts the rest of the world to some degree. So we are almost certain that we don't know the degree to which it would happen, but we are almost certain we would get a shareholder base that would not have the level of sophistication and synchronization of objectives with us that we have now. So the number one reason why most companies don't split their shares is because they may want to keep the investor quality high. Remember again that doesn't mean that the stock price will do well or that the company is great. There are many other factors that drive stock prices, but it does show that one should not buy companies just because the share is cheap. Stock splits don't increase the value of the company and by extension your shares in any way except that it increases liquidity. So now that you know why MRF's stock price is so high, go ahead and tell me, what do you think about its core fundamentals? Sure, the stock price is high, but what about its value?